Hi, my name is Luis Montalvo from Better Homes and Garden, and today I'm giving a presentation on earthquake insurance. I have the pleasure to introduce Johnny Huang from EQ Insurance. He's also the former president of the Hispanic Chamber of Commerce. So, how you doing,
Thank
Johnny?
you. Thank you for coming.
Yeah,
Thank
you're
you
very
for
welcome.
entering me.
You're very welcome. So, today we're talking about earthquake insurance. How important is earthquake insurance?
Well, I tell a lot of our folks who come to us that why we need earthquake insurance. Of course, we have auto insurance, we have home insurance, but why do people should consider earthquake? Well, you put a down payment on your house and you get a loan. You know, it depends on how big of your down payment is. So what we're looking is to save the equity of the home. And in the event of an earthquake, if the house were to shift a little bit off the foundation, the house cannot be lived in. So what are you going to do? Will you have enough money to repair it? Is there going to be enough savings in your bank account or out of your retirement to pay for that big expense? That's where earthquake insurance comes in.
Very good. In California, it's very important to have earthquake insurance. Would you agree?
I would say California, Oregon, and Washington. Although there's a lot of earthquakes in California, a lot of folks don't realize that the faults actually run all the way up through the Pacific Northwest. There's also earthquakes in Nevada and Arizona, but we're not licensed there, so we won't talk about that.
So what does earthquake insurance covers?
Well, mainly earthquake insurance covers the home, and the home is the biggest asset that we are looking to insure. The other portions are also covered are the other structures. If you have a separate barn or gazebo or a detached garage, there's also personal property that can be covered, your electronics, your furniture, your clothing, even some jewelry, depending on the certain types of jewelry. And also one of the biggest things is called loss of use. If you need room and board, so if you were to be displaced because of an earthquake, you have some insurance money to go and live in a hotel or motel or a temporary housing facility.
And that's very important. In case of an emergency, that's
in
very
case
important.
of emergency. And one thing that I want to point out is that in case of an earthquake, the massive amount of destruction that happens is not just a small house. It's not just the pinpoint of the house. It's going to be the entire area. So I argue that the loss of use is actually one of the more important ones right after the home, because in the event of an earthquake, it's not just you that's going to be displaced. It's going to be the hundreds and thousands of people, depending on the size of the quake, that will be displaced. And next thing you know, you're going to be finding temporary housing for all those people.
So basically, it is like a fire insurance where it covers, in an event of a fire, yours will cover in event of an earthquake.
Correct. And in normal fire insurance, there's other perils that is covered, like fire, wind, lightning. For earthquake insurance, it is a standalone for the peril of earthquake. The reason why there's earthquake insurance is because your homeowner's policy will exclude it. It specifically excludes earthquake damages.
That's right.
So therefore, it's wise for people. I mean, we live in a high, real estate worth area, a high real estate market area, and people have substantial equities in their home. When an earthquake happens, will a bank loan out money for you if you want to repair your home? Chances are most likely not, because the house is already damaged. Banks are unwilling to loan on a damaged house. A lot of people say, well, we can rely on the government to come in. Well, I say, what happened to Katrina? Do you really want to rely on the government? That's my argument back with them, and they said, oh yeah, maybe we can deal with it and get a loan. Well, one, it's a loan. You have to wait until the president declares the area a federal emergency area before that loan can be even applied for. And once you receive that loan, it's not as much as you think you may need to repay your $500,000 home. It's actually very small, and you have to repay that loan back to the government. That's the government backing or the FEMA back loan that for disasters. And so the first layer, what we should always consider is self-insure. If you have substantial amount of money, nest egg, retirement to repair the house, that's great. But why use your retirement to pay for it?
Right.
You can use your insurance.
And with the deductible, it covers pretty much everything.
Well, with the deductible, a lot of people should understand how earthquake insurance deductibles work. They are on a percentage value. And a percentage means that it's, let's say, for instance, the typical CEA policy, the California Authority policy writes at a 20% deductible. So if you have 20% of $500,000 home, that's pretty sizable.
Yeah.
Well, for EQ Insurance, we compete against the California Earthquake Authority. We have 5 different companies that can offer you insurance programs to cover in the event of an earthquake, but we can also offer you 5% deductibles, 10%, 15, even as low as 2.5.
Mm.
And we have one company that's really outstanding that they can write up to $10 million in home value, but you can pick and choose your level of coverage.
Mm-hmm.
So that is one advantageous position that we have over the California Earthquake Authority.
Well, let me ask you this question. What is the difference between the California and your insurance?
Well, the California Earthquake Authority is a publicly managed entity. So it was created by the state of California, and it is managed by the legislators in California. And you know politicians and you know California. When you have the government's hands in there, so, it gets a little quirky. But one thing I want to point out is that within the California Earthquake Authority's policy, there's a little small disclosure that a lot of people don't read. And that disclosure basically states that the California Earthquake Authority is not an insurance company, but it is, of course, a managed entity, but they don't participate in the California Guarantee Association. And that guarantee is very important. All of our companies that we provide earthquake insurance are part of that guarantee. And that guarantee states that if the insurance company becomes insolvent, unable to pay your claim, that guarantee will come in and step in and pay that claim up to $500,000. The CEA is not part of that guarantee. Another item of interest for the CEA is that the CEA has the right and the ability to surcharge other policyholders an additional 20% of your premium for extra money if they become insolvent. So if the CEA runs out of money in the event of an earthquake, they have the right to go to all their 800,000 plus policyholders and ask for another 20% more on your premium. Would you want to buy an insurance policy where they ask you to pay for more for somebody else's issue? No.
I wouldn't.
No. That's what insurance is for. It's for your own risk. You pay the money and you are supposed to benefit from that contract. The California Guarantee Association, within that disclosure, allows them to assess an additional premium because they need it. So if LA has a big earthquake, guess what? They're coming up to San Francisco and all the North Bay policyholders and asking for all that money, and including the folks down in LA. So that's the biggest difference.
Well, I'm glad that you explained that.
Thank you.
So my name is Luis Montalvo from Better Homes and Garden, educating the public, in this case in earthquake insurance. Johnny, thank you so much for the time. It was a pleasure.
Thank you for this opportunity.
You're very welcome.
To talk to you soon.